Why don't the rich pay taxes? Imagine this. You work a full-time job, pay your bills, maybe save a little, and at the end of the year, you get hit with a tax bill that eats into your hard-earned income. Meanwhile, billionaires like Robert Kiyosaki and Donald Trump go on television or publish books boldly proclaiming that they don't pay taxes, and in many cases, they're telling the truth. That contradiction, where regular folks like you carry a heavy tax burden while the ultra-rich seemingly escape it, feels deeply unfair. It makes you wonder, how do they get away with it? And more importantly, why doesn't the government stop them? Isn't not paying taxes illegal? The simple answer is yes and no. The truth lies in the difference between two very different concepts: tax evasion and tax avoidance. One is a criminal act that can land people in prison. The other is a clever, entirely legal strategy used by those who understand how the tax code really works. Rich individuals, corporations, and their advisors don't necessarily break the law. Instead, they bend it to their advantage, exploiting its loopholes like expert chess players manipulating a board. You might be wondering why some people get arrested for not paying taxes, while others boast about how little they contribute to public coffers. The answer lies not just in money, but in access to knowledge, legal tools, and systemic privilege. It's not that the wealthy don't pay taxes at all, but they often pay far less than you'd expect, and in ways that are perfectly legal, though ethically questionable. In this breakdown, we'll dive into both illegal tax evasion and legal tax avoidance, exposing the real-life tricks and corporate maneuvers that allow the rich to keep more of their money, while the rest of us wonder how the system got so skewed in the first place. Tax evasion, the illegal route to keeping more money. Tax evasion is the dark side of the tax world, a world where individuals and businesses intentionally deceive the government to avoid paying taxes. Unlike legal tax strategies, tax evasion is a crime. It involves outright lies, hidden assets, and fabricated numbers. If caught, the consequences can be severe: heavy fines, legal penalties, and even prison time. But despite the risks, many still take this route, hoping to outsmart the system. So how does tax evasion work in practice? One of the most common tricks is underreporting income. Let's say Bob wants to buy a house from John for $700,000. But both men want to avoid paying the full 10% tax on the sale. So instead of reporting the true price, they falsely declare that the house sold for only $500,000. The difference? They save $20,000 in taxes. Bob still pays John the full amount under the table, but the government only sees the fake transaction. This might seem clever, but it's illegal. Both parties are lying to tax authorities, and if discovered, they could face serious charges. Another widespread tactic is hiding assets in offshore accounts. For years, countries like Switzerland were known as tax havens, places where the wealthy could safely stash their money away from prying government eyes. For example, imagine Tom, an American millionaire, earns substantial income but doesn't want to report it. He opens a secret account in Switzerland. Thanks to the country's former strict banking secrecy laws, U.S. authorities had no way of knowing the money existed. Tom avoids taxes entirely, but this trick isn't as effective anymore. Global pressure forced Switzerland and other havens to start reporting foreign account holders. Still, the legacy of offshore hiding continues in other jurisdictions. Then there's the false deduction scam. Businesses, especially small ones, can manipulate expenses to reduce taxable income. Picture Sarah, who owns a pizza restaurant. She makes $100,000 in revenue and is supposed to pay $20,000 in taxes. But instead of spending $30,000 on real renovations, she only spends $3,000 and falsely claims the full $30,000 to the IRS. On paper, she appears to owe just $14,000 in taxes. In reality, she keeps more money by lying about her costs. In short, tax evasion is about lying, concealing, and manipulating. It's risky, it's illegal, and it's not something the average person should try. But for those who think they won't get caught, the temptation can be powerful, and the game, high stakes. Tax avoidance, the legal art of paying less, while tax evasion is illegal and punishable by law. Tax avoidance is a completely legal, yet highly strategic way to reduce tax bills. It doesn't involve lying or hiding income, but rather understanding the system so well that you can use its rules against itself. This is where the rich truly shine, not by breaking the law but by mastering it. The first, controlled foreign corporations, CFCs, making profit disappear. One of the most powerful tools for tax avoidance is creating a controlled foreign corporation, or CFC. These are companies established in countries with extremely low or zero corporate tax rates, often referred to as tax havens. By routing income through these foreign entities, businesses can shield profits from high-tax jurisdictions. Take Apple, for example. Yes, the tech giant behind your iPhone. From 2009 to 2012, Apple avoided paying an estimated $44 billion in U.S. taxes. How? By setting up shell companies in Ireland, a country known for its favorable tax laws. One such entity, called Apple Sales International, had no employees, no physical office, and no meaningful operation, yet it was responsible for holding billions in profits. Here's the trick. Ireland defines a company's tax residency based on where it is managed, while the U.S. defines it based on where the company is incorporated. So Apple created a company incorporated in Ireland but managed from the U.S., allowing it to fall into a kind of legal gray area where neither country taxed it. This tactic, though controversial, was entirely legal under both countries' laws, until reforms closed some of these gaps. The second, transfer pricing. Internal transactions that shift the tax burden. Another clever trick used by corporations is transfer pricing. This refers to pricing goods, services, or intellectual property between subsidiaries of the same company in different countries. The goal? To shift profits into countries with lower taxes and minimize exposure in higher tax areas. Let's say John runs Wee Shoes Corporation, headquartered in the United States. His company develops a new shoe model that becomes wildly successful, generating $1 million in profit. Under the U.S. corporate tax rate of 35%, John would have to pay $350,000 in taxes. But John has a plan. He sets up Wee Shoes Cayman Islands Limited, where the corporate tax rate is 0%. He transfers all intellectual property, like the patents and branding, to this new company. Now, whenever his U.S. company sells a pair of shoes, it must pay licensing fees to the Cayman Islands subsidiary for using the Wee brand. So, out of the $1 million in income, the U.S. company claims it owes $800,000 in fees to the Cayman entity. That leaves just $200,000 to be taxed at 35%, resulting in a much smaller tax bill of $70,000. Meanwhile, the $800,000 sits tax-free in the Cayman Islands. Of course, there's a catch. John can't simply bring that money back to the U.S. without paying taxes on it. But he can keep it offshore, reinvest it abroad, or wait until tax reforms allow him to repatriate it at a lower rate. In fact, when the U.S. corporate tax rate dropped to 21% in 2018, companies like his could bring back foreign income at a significant discount. If John waited and repatriated the $800,000 under the 21% rate, he'd pay only $168,000 in taxes, keeping $762,000 instead of just $650,000 if he had paid the full 35% initially. That smart timing turned into the next, dividend income versus salary, why Buffett pays less than his secretary. Another legal tactic is changing the type of income you earn. Regular workers get paid salaries, which are taxed at standard income tax rates. But the rich, they earn money through dividends and long-term capital gains, which are taxed much more favorably. Warren Buffett famously pointed out that he pays a lower tax rate than his secretary. How is that possible? His main income isn't a salary, it's dividends from investments and profits from long-term holdings. In the U.S., qualified dividends and long-term capital gains are taxed at 15% to 20%, while regular income might be taxed at 22%, 24%, or even higher. Let's compare. A person earning a $100,000 salary might owe $22,000 to $24,000 in taxes, but someone earning $100,000 in qualified dividends could owe just $15,000. Now imagine that income scaled up to millions or billions. That difference becomes staggering. It's not about cheating the system. It's about structuring your income to fit into tax-favored categories. While most people can't do that, investors, executives, and business owners can. Finally, is it ethical? This is where things get murky. Everything mentioned so far is technically legal, but is it ethical? That's a question society is still wrestling with. These strategies often rely on deep financial engineering, expensive legal teams, and political lobbying. Many believe the wealthy have not just mastered the rules, but influenced them to work in their favor. The result is a system that feels rigged. Everyday workers who rely on salaries end up carrying more of the tax burden, while those with wealth and the knowledge to maneuver it can dramatically reduce what they owe. Critics argue that tax avoidance, while legal, undermines social trust and leaves governments underfunded for essential services. Yet for the rich, it's not about breaking the law. It's about winning the game. And in this game, the one who knows the rules best often keeps the most money. Tax deferral, delaying the inevitable. While tax evasion and tax avoidance focus on either breaking or bending the rules to minimize tax payments, there's a third strategy used by both average earners and the wealthy: tax deferral. Unlike tax avoidance, which seeks to reduce the total tax bill, tax deferral is about postponing tax payments to a later date, often when the taxpayer will fall into a lower tax bracket or have access to more favorable rules. Think of tax deferral as saying, "I'll pay, but not today." One of the most common examples is the 401k retirement account in the United States. When employees contribute to a 401k, they don't pay taxes on that income immediately. Instead, the taxes are deferred until they withdraw the money in retirement. The logic is simple. People typically earn less in retirement, so the taxes owed will be lower than if they had paid them during their peak earning years. Another classic deferral tool is the 1031 exchange in real estate. If an investor sells a property and uses the profits to purchase another property of similar type, they can defer paying capital gains taxes. This allows real estate investors to keep building wealth without the tax interruption that usually comes with selling valuable assets. Then there are IRAs, individual retirement accounts, and other structured savings vehicles that allow income to grow tax-free until a certain point. Tax deferral doesn't eliminate taxes, it simply delays them. But in the hands of strategic planners, this delay can translate into decades of untaxed growth and huge future advantages. The game you're not taught to win. In the end, the gap between how the rich and the rest approach taxes isn't just about money, it's about knowledge, strategy, and access. Regular people often live paycheck to paycheck, having taxes automatically deducted from their income. Meanwhile, the wealthy operate in an entirely different world, where tax is a game of chess, and every move is calculated. What we've seen is this: tax evasion is illegal, reckless, and punishable. But tax avoidance is legal, though ethically debatable. And tax deferral allows for long-term planning that can snowball into enormous financial advantages. Each of these plays a part in the massive tax gap between the wealthy and the average taxpayer. The shocking reality? The system isn't broken, it was built this way. Many tax codes have been influenced or even written with the help of lobbyists, lawyers, and billionaires who understand how to create rules they themselves can exploit. That's why when someone like Warren Buffett pays a lower tax rate than his secretary, it's not a glitch, it's the result of precision planning. So what can you do? First, educate yourself. Understand the rules, the incentives, the deductions, and the structures available. You don't need to be rich to start thinking like the rich. Second, question the system. Demand transparency, support reform, and push for fairer tax codes. Because in a world where those who know the rules get to keep more of their money, not knowing the rules means you're playing to lose.